What's going on, guys? Welcome back to the channel. My name is Mark and this is 360 Finance. So quick disclaimer up here on the board, just because a few people have reached out to me in the last few weeks. I've been a lot more active on social media, in particular Instagram and Facebook. Links are in the description if you want to follow me. But in particular, I just want to say I'm not a licensed professional here, okay? You have to do your own research when you're investing your own money in the stock market. The reason I didn't post this video a few weeks ago, this clip was recorded a few weeks ago. A, I just didn't have time to edit it. But two, I felt the video came across as a little bit whiny. And some people in my life personally have advised me that some of the content is coming across as extremely negative or whiny, and that I'm calling for some sort of market crash here, which is certainly not the case, okay? So just quick disclaimer, I'm not a licensed professional. Do your own research before you invest your own money, and just make sure to take into account the risks involved when investing in the stock market, okay? I'm not calling for a stock market crash. I'm simply providing you the information for you to make your own decision, okay? So hope you guys enjoy, and I'll see you guys in the clip. Okay, in today's video, I want to talk about that famous Warren Buffett indicator. If you guys follow me on Instagram or Twitter or on Facebook, you would have seen me post it earlier this week and basically say that it's reached a new all-time high, okay? And this is what Warren Buffett has always said is the single best measure of valuations at any given point in time, but it doesn't come without its limitations. And I kind of want to talk about that in this video. So let's just go ahead and get started, okay? So the famous Warren Buffett indicator is the total market cap of any country over its GDP, okay? And what that does is it measures the total value of all the public companies trading on the market, essentially, and divides that by GDP. Typically in the US, when we see it go over 1 or 1.15, people will typically say that's overvalued, but it's been over 1 since 2013. So, a lot of people have begging to differ, like, are we going to see some dip in equity markets moving forward? Well, it's basically continued to rise all the way up to like 1.86 or 2 where it's sitting at right now, which is basically indicating that the total market cap of the US market is worth twice as much as the annualized GDP. Now, the second thing is that you can calculate GDP in a couple different ways. The first one being the income approach, and the second one being the expenditure approach. There's a couple other ways you can do it too, but just for the sake of this video, these are the kind of like two simplest ones. The other models are a little bit more complicated. But the expenditure approach is basically the total amount of money that everybody has spent on goods and services in a country in a given year. And the income approach is basically what that production has earned, entrepreneurs and companies in any given year. I don't want to go too in depth on how GDP is calculated because it's not really in the scope of this video. Just want to let you know that you'll get a different number for GDP depending on which approach you use. My third point here is kind of the ranges of where investors have historically said the market is over, under, or fairly valued. If you pull up something from Investopedia right here, you'll see that, anywhere from 0.75 to 0.5 people would typically consider undervalued in the US. Anywhere from 0.75 to 0.9 people would consider fairly valued, and then above that, overvalued, of course. As you obviously know by me just posting this graph right here, you can see it's sitting at an all-time high, almost at 2. Now, there's a lot of limitations to this indicator, and that's kind of what I want to get into in this video. So this is going to be the meat and bones, or the meat and potatoes of this video. But the first one is time periods, okay? So when comparing different time periods, it may not be a completely accurate reflection of a country on any given year, depending on what occurred in that year. Now, you can obviously use 2020 as a case study and say that the economy will never shut down again or never should shut down again. Therefore, GDP should never be as low as it was in this given year, which might artificially inflate the Buffett indicator. For instance, the total value of all publicly traded companies versus all unlisted companies in any given year is probably going to be disproportionate. So for instance, when you talk about new IPOs or like some of the tech companies that have emerged in the 2010s and things like that, those years are obviously going to be different from when you don't have those type of companies in the market. They're unlisted or they're just still private. The second limitation is the country to country comparison. So each country is going to have a different market or a Warren Buffett indicator because their market is completely different, okay? Every country is going to have a certain number of multinational companies in them, which is going to kind of skew that country's origin GDP from where it's sitting at today, just because companies or multinational companies from other countries having operations in their land is going to kind of skew that GDP. And the best case for this is Hong Kong, and their Warren Buffett indicator is like over 10. It's over 1,000%, and that's just not a good reflection of what this market cap or what this Warren Buffett indicator is meant to do. It's meant to measure the total value of all companies in any given country against its GDP. So like the total aggregate value of all final goods and services that were sold and or produced, right? Capital market size, which is another big limitation. This kind of feeds into, the country to country limitation. Each capital market is going to be different, whether it's developing or, a developed country, nation. And that's just going to, again, force every country to have a different Warren Buffett indicator that's going to be reflecting something unique to its circumstance. Profits as a percentage of GDP is one of the last limitations I want to list here. And that is essentially, a good example here is Saudi Aramco, the biggest oil company in the world, contributed something like 12% of corporate profits as a percentage of GDP alone to the corporate profits of Saudi Arabia. In the US, that typically ranges anywhere from like 5 to 12%, and in India that ranges anywhere from 2 to 4.5%. So you can see how that would kind of skew everything, and that also kind of just feeds back into the country to country limitation. Every country is going to have its own unique circumstance, which is going to have its own unique Warren Buffett indicator. Now, my thoughts, okay? I know this last point, it doesn't say my thoughts, it says quantitative easing, but I don't really want to explain what quantitative easing is in depth because it comes in many different forms and it's highly technical. But, at its very truest form, or like the easiest way to describe this is, when people lost their jobs in mid-March of 2020 and the central banks worldwide started digitally printing money to give people stimulus checks, or in Canada, there's things called the Canada Emergency Response Benefit, which is, CERB, the Canada Emergency Wage Subsidy, and all the emergency benefits that the government of Canada has provided. But in the US in particular, how people were just getting stimulus checks, gratuities basically that you don't have to pay back, that are not taxable income. That is quantitative easing, okay? Point here is quantitative easing, but I want to kind of just more so talk about my thoughts on this whole indicator, its limitations, and where it's sitting at for the US right now, okay? This Warren Buffett indicator is so elevated, and I used to think it was, the be all, and wherever it's sitting at, that's, where equity markets are moving forward. But in fact, there's limitations to it because I think its inflation up here is actually justified based on the amount of quantitative easing that we've seen worldwide, right? And what I mean is when you give people stimulus checks, you're increasing the money supply on the market, or you're just increasing the circulation of cash in the economy. And when that happens without actually increasing the amount of goods and services sold and or produced in a country in a given year, that's going to artificially inflate this indicator, because everybody's going to take those stimulus checks and they're just going to throw them in the stock market. So in fact, this is kind of justified, right? But at the same time, I don't want to say that it's sitting up here means it's going to stay up here, okay? If the past is any indication of the future, whenever we see sharp increases in this indicator, which we have in recent years, there's a sharp decline in equity markets in the near term, okay? So I guess I'll finish off with that, and just give my word of caution to investors. I'm not trying to sway you in any different way to tell you to buy or sell any given security or change the allocation of your portfolio. This is simply my opinion. I'm not a financial advisor. Do your own research, obviously, when you're putting your capital at risk. All right, guys, that's pretty much all I have for you guys today. I hope you guys enjoyed this short video. If you did, smash the like button, subscribe to the channel, follow me on social media, and share the video with a friend if you learned something. All right, I'll see you guys in the next video. Peace.